Road. All right, well, welcome everybody. This is Jim Musgrave, and thank you for attending my Q1 2023 State of the Markets webinar here. So we got a lot of great share with you tonight. So I'm going to kind of first start off with the agenda. So what I'm going to cover is going to do a recap of the markets. We're going to do navigating the bear market recession obstacle course, and how are we going to kind of get through this period. Also, how to best position your portfolio in 2023. We're going to cover some of the new tax laws that are happening with the Secure Act. And also, we're going to put the pieces together and show you how to compare various strategies, different strategies that'll work best for you. So we actually have some new software. And anyway, so we're going to kind of share that stuff with you. So I think I'm going to kind of start off with a poll here. And so let me go ahead and start the first poll. And so the first poll is, how concerned are you about a bear market recession? Either not concerned, somewhat concerned, or very concerned. I'm just kind of curious to see what you guys are thinking. So, and again, if you should be able to see the poll. And then, there's actually in the upper corner, you can actually, once I close the poll, you should be able to see the results right there. So anyway, hey, all right, thanks for putting those responses in. All right, so I'll give you another few seconds to kind of put in your poll in right there. So very good. All right, well, I'm going to go ahead and close the poll. And it's interesting to see that about 2/3 of you are very concerned. Okay, well, this is good. I appreciate the feedback. All right, I actually have another poll question. I only have 2 poll questions the whole seminar, but here we go. The next polling question is, so if the market dropped another 20% in 2023, what would you do? Do nothing, stay the course? Make minor changes, sell some equities, raise some cash, and wait for an opportunity, or sell everything and stay in cash until the market comes back? I'm curious to see what you guys would do in this situation. So you just kind of feel free to kind of put in your answer there. So if the market drops another 20%, what would you do? Would you kind of just do nothing, kind of stay the course, make minor changes, sell some equities, maybe raise a little cash, wait for an opportunity? Or like, you know what, I just don't feel comfortable. I'm done. I'm going to get out and kind of go into cash and just kind of wait till the market comes back. So I'll wait. We got some good response here. I appreciate your participation. So, okay. Well, I'm going to close the poll right here. And if you look at the answers, everybody, it looks like about, 57% of you said to make some minor changes. And about 29% said, sell some equities and raise some cash. Well, very good. I mean, I think that's kind of par for the course. The trick is always the timing, right? I think the getting out is a little easier. I think getting back in is the bigger challenge. I've seen people who got out and just missed out on a huge bull run, after a really bad pullback. So appreciate your participation. Okay, so, and by the way, just if you guys have any questions, you can put in the Q&A or the chat, and what I'll do is I'll try to answer this question towards the end. But here we are. I love this little graphic. We have the stock market, people on the roller coaster ride getting sick, and the guy says, the stock market expert says, hey, no, everybody stay on board, everything's fine, let's go again. So, but that's kind of, what's happening right here. And so what I want to do is kind of first kind of take you to my website. And I'm going to kind of change my screen here real quick. And what I want to share with you, if you guys haven't been on my website recently, I'm going to give you just a quick tour. So this is here's the website right here. And if you scroll down, you're going to see these 8 boxes that have, 8 areas that I work in. I do more areas, but these are the main 8 areas I work in. But if you scroll right down here, you're going to see three different market outlooks. You're going to see this the global market outlook by BlackRock. You also see Anatomy of Recession and also the Guide to the Markets. Now, if you click on these, the first one that's going to come up here is the BlackRock, the new investment playbook. And this is really good. You can click this PDF right here and read it. And it talks about lots of different things. The other thing you can do is go up here under Insights and Education. And I always click on the weekly commentary. What you're looking at here is the Global Investment Outlook, but you can also look at the BlackRock Investment Institute. But BlackRock has some great educational sources right there on your website. So I made it really easy for you to access it. All you got to do is go to my website and click on the link, and there you go. The other link is Anatomy of a Recession. And I saw this guy, Jeff Schultz, down at the ETF conference a number of years ago, and I really like where he's coming from. And a lot of the information from tonight's presentation kind of came from the Franklin Templeton Anatomy of a Recession presentation. And you can watch a video. Every month they record a video. And so I highly recommend that you watch it. But the main thing I want to kind of point out right here is that they have their U.S. recession risk indicators. And what's interesting, here we are 2 weeks into February, and you can see right here that we're seeing more and more red X's. And if you kind of scroll down to the bottom, the overall signal is a recessionary signal, okay? If you just go back to June of last year, things weren't looking as bad. You had more green arrows. We're kind of more in a green arrow kind of posture. And if you look at July, we got more cautionary, then things kind of went downhill last fall. And so what's interesting is that the consensus across the board is that we're most likely going to have some sort of bear market recession, but the consensus is it's not going to be nearly as bad as what we had in 2008 or 2000 to 2002. So yeah, could the market drop more? Absolutely. Are we going to have a 2008 situation when you have a financial crisis? Very slim chance of that happening. But the point is that whether it happens or not, you've got to be prepared. I've got to be prepared for this stuff. So we're going to kind of share some different strategies that you can use no matter what the markets do to ultimately put yourself in a better position. So you can scroll down on this, and if you want to kind of get in the weeds a little bit, it actually talks about some of these indicators. The yield curve, we're going to talk more about that tonight for sure. And you're going to see an inverted yield curve, which is a big recessionary indicator. You're going to see that's so it's the indicators are overall really kind of flashing a recessionary period. Okay, so anyway, so this Franklin Templeton website is fantastic. Again, the way you get to it is just you go to my main page and you just scroll down here and click on the little link right here. And I update this pretty frequently. Actually, every quarter I update it. Okay, now the other thing I want to kind of share with you is this. Okay, I'm just going to do this very, very quickly. But if you go to these different pieces on the website, one thing I was going to show you was the retirement planning page. Well, right here, we have our retirement planning process. You can download that brochure. We actually have a retire ready or not calculator that you can click on right here. And it kind of takes you that and kind of gives you an idea, are you on track to retire, which is really kind of neat. The other thing I've integrated in the website is a lot of educational workshops or a lot of videos. And so we've got just videos kind of scattered around the website. This is great. The Debtor Saver Wealth Creator, the decisions that you make just in financial decisions in general have a greater impact on your wealth than rates of return in your 401k. So we have all sorts of videos right here, pay cash or finance, how to pay for major capital purchases, weddings, vacations, those sorts of things, and the 4 toughest questions that you need to know. So I always, encourage people to, watch these. The other thing is that I'll take you to a couple of pages and I'll move on. We have the money management page right here, where we have a way to stress test your portfolio. And also we talk a lot about tax efficient investing. One of the things we're always trying to do is minimize the taxes. in our clients' portfolios. And so we've got different ways of doing that. I've also, for many of you are current clients of mine, and many of you attended my Dividend Plus webinar I did back in December. And so we actually have a recording of that right here on the website. Larry Taunt, the portfolio manager, I interviewed him. We had a great interview. And we also have a little brochure right here. And again, we talk a little bit more about the difference of our portfolio analysis report. So again, when we have accounts, especially accounts that I don't manage, and you want to say, well, how are they doing compared to what you're doing, Jim? Well, let's compare. We can actually run a detailed report. And so we do that pretty frequently. And I always suggest people to learn more about sustainable investing, factor investing. We have those things right here. We also have our fee schedule right here on the page. One other page I wanted to talk to you about, ironically, is the life insurance page. So one of the things that I feel that, again, we're a full service, firm. We specialize in retirement income planning. Yes, we manage a lot of money, but also equally, we also believe in insurance products. And one of the biggest, most versatile tools in the toolbox is cash value life insurance. And so this is a 10-minute lesson on life insurance, which is important. And also there's a concept called the private reserve strategy. And I'm actually in the process of kind of building some presentations that we talk a little bit more about that, but you can watch this video right here. And it's a way that you can ultimately use collateral to actually make major capital purchases. And so we've got great videos right there that kind of show conceptually how to do that. And the other thing is that I got a great little thing. There's a lot of you are federal employees. So we've got a lot of stuff on the TSP and federal benefits. We also have TSP rollovers. And so you can see right here, we have a whole section on here, reasons to roll over your TSP or your 401k, or reasons to leave. And so I encourage you guys just to read this. Again, I've really designed my website as an educational tool, and I hope you guys take advantage of it. Okay, so let me, I just want to give you just a quick introduction to that. I'm going to kind of switch my screen and go back to the PowerPoint right here and kind of move on. Okay. So as I just kind of showed you, the indicators are showing sort of a recessionary posture in the markets. And again, this is actually the most anticipated recession ever. I mean, we've been kind of seeing this for well over a year now, and the primary reason is that, again, the inflation just kind of took off, and we knew that the Fed was going to raise interest rates to try to cool down inflation, and we've known that for well over a year. And so the Fed did a lot of that in 2022, and most of the raising of the interest rates happened in 2022. We're going to see a slight, the rate of increasing of the interest rates are going to kind of slow down a little bit. But again, this recession is nothing new. I've been talking about that for well over a year, and kind of sharing ways that we can kind of address that and navigate these waters. And one of the things that one of the leading indicators that I kind of taught you about was the inverted yield curve. And so when you look at the yield curve, that just means that the short end of the curve, the short-term bonds and CDs have a higher yield than the long-term or the intermediate term. And so what we've seen is that you go back to the 60s. When we look at the past bear market recessions, we've seen the yield curve. What did the yield curve do right before those bear market recessions? And you can see in most of the times, they were a good, very reliable leading indicator that kind of shows a bear market recession. So again, this portion of the yield curve has anticipated 8 of the last 8 recessions with no false positives. Okay, so that was one reason why the institutional managers, and also including myself, kind of feel that a bear market is fairly inevitable. And this is a great graphic. It's called the U.S. Treasury's yield curve. So if you look at the lower left, let's say you just look at a 1-month Treasury bill, or I just kind of you can look at CDs. So you've got a 1 month, 3 months, 6 months. And you can see that you can get nearly 5% and basically a 6-month CD right now. Okay, but look how the yield curve falls off after 1 year. I mean, so you go 2 years out, now you're looking about 4.5%. But look at the 10-year yield curve. You're down under roughly about 3.7 ish. So this is something just to kind of be aware of is that if you are concerned about losing principal and you want to have some money in the safe tank, laddering short-term CDs right now is actually a really good idea. You can get a higher yield on a 6-month CD than you can a 3-year CD. Very interesting. So I love this graphic because it kind of shows you literally what I mean by the yield curve. And what I mean by the short end of the curve, that's the 1 month, 3 month, 6 month, and the long end is on the far right where you see that's a 30-year. So typically in normal markets, the further you go out, the yield is higher. But again, we are in a period of an inverted yield curve, and that typically happens when the Fed raises interest rates. And that's kind of what's happened over the last year or so. So that's pretty interesting. Okay. Now, again, what's really interesting is how the CEOs, CFOs feel about the markets. Now, what's interesting is that the bad news is that most of the CFOs, the confidence about the economy is at a near recessionary levels. You know, a lot of the CFOs of these major Fortune 500 companies don't really have a whole lot of confidence that we're going to not be in a bear market recession. But the good news is that they actually feel fairly confident about their own businesses. And so we've seen certainly sectors in the tech space for sure that have started to laying off people for a variety of reasons. But the overall unemployment rate still remains pretty low, and the employment is remaining pretty strong. So we're just in a very interesting kind of period with this with the economy and what's going on right there. So yeah, I think overall, I think companies feel reasonably good about the shape of their businesses. And when we have a bear market like we had last year, and again, I'll show you the slide for the next one for this year right here. But what happens is that markets don't go in a straight line. And you can see that there are certainly counter trends in a down market. And you can see on the left, you go back to 69 and 70, we've had, trends, we had positive times where the market goes up 6, 10, 11, 4, 12%, so there are times when the market can have a nice rally, even in a down market, And this is the S&P 500 as of yesterday. So if you look at the far left side of your screen, you're going to see that green vertical line. Well, that was January 1, 2022. So basically the market peaked in the first week of January 2022, a little over a year ago, and then it dropped, and then it kind of rallied a little bit. And you see that purple line on the bottom, that's what we call, that's the trend line. So what happens is that the bottoms, when the market drops and then it has a rally, what happens is that the bottoms are lower, and when it rallies, the highs are lower than the previous high. So you can see all throughout 2022, when the markets rally, I mean, look at that big old rally in mid-June to beginning of September, or late August. I mean, that was a huge rally right there. But that rally did not break the resistance, and it didn't get as higher than the previous rally back in early April. And then there we are in early September. We had another big drop until the market lows in October. Then we had a nice little rally in the fourth quarter, little drop, right before the end of the year. But look at January 2023 to the present. The market has had a nice rally. And that big fat red line that you see in the middle is the 200-day moving average. So up until just recently, in the last month or so, the market has been below the 200-day moving average. Okay. So this proves my point, right? Because yeah, the indicators are we're going to be in a bear market recession, but look at what the market has done in the last 6 weeks. We've had a nice little rally. Okay. So when you free up money, when you sell equities to go into cash, yeah, you can do that But man, you better be watching the market every day, and you better you better be a pro, because that's where people tend to make lots of mistakes, is that they try to, getting out is easy, right? It's getting back in and knowing where to be is the hard part. So what happens is that if you raise a bunch of cash, then you're going to miss out on these things. And typically when a rally hits, there's like 7 to 10 days that really make a lot of difference. So if you're missing out on those days, that can really hurt your performance. So what we try to do, and I'm going to talk about this just a little bit later, is that we try to stay fairly fully invested, but you can change how aggressive or defensive you are within that allocation. Okay. So that's what's been going on with stocks. That's also what's going on with bonds. So again, you go back to January 2022, again, as the Fed was raising interest rates, as interest rates go up, bond prices go down. And you're going to see in just a minute that bonds had their worst year, probably the third worst year, if not the worst year in the last 100 years. Okay, it doesn't happen very often, but we've seen a little bit of a rally in bonds. But so you're going to see the kind of the push and tug and pull of the bond market. Just again, the bond market's kind of reacting to the Fed raising interest rates and so forth. And so, but you can still see that the bonds are still underneath that big fat red line, which is the 200-day moving average. Okay, so most asset classes lost money in 2022. About 105 out of 112 asset classes lost money. All right, well, Jim, which ones made money? Well, what made money last year were energy and some commodities. Okay, so that's one thing that we absolutely had exposure to last year, were segments of the energy sectors as well as commodities, and so this certainly helped the performance. So so those are the two areas that we're making decent money last year. But you can see, again, this is just last year, 2022. I mean, it wasn't until 2008 where 94% of all the different asset classes lost money. So again, this hasn't happened in a while. And again, it was the worst year for bonds and the second worst for stocks in 2022. So look at it, the worst year for bonds. Last year, bonds were down -13. But I want you to look at below that, 1994, 1931, 1913. Typically, when you've had a negative year in bonds, the next 12 months are positive, with the exception of 2021, 1958, and 1955. So we actually see real opportunities in bonds right now. And so we actually, we actually think bonds are one of the better opportunities at this point, because they were dramatically oversold last year. And again, for the seventh worst year for stocks. Again, the stocks are down -18. But besides the really, really bad bear market recessions, 2001, 73, 1930, that was a Great Depression. And most times, many times that the stocks have really rallied. Now, who knows what's going to happen with equities in 2023? It could go either way. But regardless, is that we still feel kind of being fully invested, but having a tactical tilt is going to be the way to navigate that. I'm going to be talking about that a little more in detail in just a minute. Okay, so I love this slide right here because it shows you the returns following bad periods for bonds. Again, the worst one-year bond periods have tended to have very positive returns 1 year later. Okay. So again, on the right side of your screen, following the worst 1 year price returns for bonds, stocks have averaged 13% positive, and bonds over 15.5, around 15.5%. Okay. So again, historically speaking, when bonds have really lost money like they did last year, historically speaking, they've done pretty well. I think stocks is a little bit more of an uncertainty, but bonds certainly look pretty likely that they're going to do fairly well in 2023. And again, just kind of give you some statistical data. Stocks lost money in 2022 for the 26th time. So, and I got another slide coming up in a second that only 26 times in the last roughly since 1926, nearly 100 years, stocks have had a down year. So again, the average return for U.S. stocks after losing a year about 13%. The median return for stocks after a losing year is about 21. So again, on average, stocks have rebounded. Okay. Now, are we there yet? Well, again, this came from that Franklin Templeton Clearbridge presentation. Again, go on the Franklin Templeton website and download it. You can get lots of great information. But again, since World War II, the average recessionary sell-off has been about negative 30, at a level that the current sell-off is approaching, but has not reached yet. Okay, so again, we had sectors in the, like the tech sector last year was down over 30%, 30, 35. SP is down roughly 18. Could it drop more? Yeah, it could. Although we're off to a good start so far this year, right? So, this just kind of gives you an idea too that when we are nowhere near where we were 73, 75, 2001, or 2007, 2009. Okay, we're about roughly half of where we are. So again, we're in a bear market. Technically, we're not in a bear market recession. We'll see what happens. Okay, let's kind of talk about kind of navigating this bear market recession obstacle course. So for many of you, I've shown this to you before. This is what we call the personal economic model. Okay, and I won't go into all this, but ultimately, I'm able to visually show cash flow on the PIM. And what I'm showing right here is a typical financial picture of the typical person. You've got money in the risk tank. There's typically your investments. You've got money in the safe tank. That could be your fixed income. It could be fixed annuities. Could be fixed index annuities. Could be cash pay life insurance, CDs, cash. Those sorts of things could be in the safe tank. Many of you are homeowners. Many of you have a mortgage, and so that there's a liability for the for the mortgage. So, but that's basically the situation. So I just want to kind of talk about conceptually, like what's going on right here. We know that bear market recessions happen, right? It's just part of the market cycles, okay? So when we do planning, so if you're on this call, you're either in the accumulation phase where you're trying to fill those tanks and make as much money as you can, or you're in the distribution phase where you're trying to keep you're trying to maintain those investments and then preserve that capital for the rest of your retirement, right? So depending on where you are in your life cycle will determine how much you have in the risk tank and how much you have in the safe tank. Okay, but since many of you here on the call are either retired or close to being retired, this is, as the closer you get to retirement, the more you want to have money in the safe tank. Okay, and if for those of you who may not be familiar with this, you see a cap on the top of that safe tank, which means that that principal is protected. Okay, so kind of philosophically, we're going to talk a little bit about how to kind of navigate this stuff if you're retired, but just understand that the risk tank is going to go up and down. Okay, we can reduce the volatility of the portfolios in the risk tank to an extent, but just understand is that there's pros and cons of getting super defensive or raising a ton of cash, because we just kind of talked about that markets don't go in a straight line. And if you're in cash sitting on the sidelines, just kind of waiting for things to turn around, you could really miss out on these little rallies that could be 5, 10, 20, even 20% in a bear market. Okay, so that's one reason why we kind of feel philosophically that you want to stay fully invested. But with that being said, you can let your foot off the gas a bit, or you can get more defensive in the portfolio that's in the risk tank to kind of minimize that volatility. And I'm going to be talking a little bit more about that. So ideally, if you're in retirement, you want to kind of pull money from that safe tank and allow you to have time for the risk tank to kind of rebound, as things get better. Okay, so let's talk a little bit about fixed income. And I just kind of put a definition. It's a type of investment security that pays the investor a fixed amount over a fixed schedule. And we typically put fixed income in the safe tank. Now, with that being said, full disclosure, are bonds safe? Are they? Can bonds lose money? Absolutely. I just showed you a slide of the bond market, and that bonds lost 13% last year. Okay. Generally speaking, we think about bonds being in the safe tank, but you could certainly argue that if the principal is not protected, should it be in there? Okay, I'm just trying to get you to think. Just part of this is education, right? Bonds are typically part of that fixed income part of the portfolio. Just understand that bonds, that value, the net asset value, can fluctuate as time goes on as well. Okay, so one of the things is that, okay, so the question is, why do you have bonds in a portfolio? Well, there's a number of reasons to have bonds in a portfolio. One is that in many cases, not all cases, last year being an example, bonds tend to kind of move in opposite directions of stocks, generally speaking. Did that happen last year? No. Both stocks and bonds went down at the same time last year, okay? But we typically have bonds in a portfolio to diversify and hopefully be somewhat of a downside cushion when equities drop. It doesn't always happen, but it can certainly help. The other reason is to have some sort of yield in the portfolio. And a lot of return that comes from both stocks and bonds actually comes from dividends in that portfolio. And so we've kind of talked about how that again, as the Fed raises interest rates go up, bond prices go down. So on the left right there, you can see, well, what happens to returns when rates rise 1%? Well, again, you can still see that things can be in a positive, can still be positive. If there's no change in rates, the investment grade bonds, 1 to 3 years, can be even better. And actually, as rates fall, that's when bonds tend to do fairly well. So what we see in 2023 is that, where we are in bonds is that the yields are becoming more and more attractive. And I think one of the big opportunities right now is actually in fixed income. And so you're looking at new bonds, we're paying coupons of over 4% compared to 2% a year ago. I mean, you go back even 4 or 5 years ago or less. I mean, you just weren't getting any yield on anything. The yield was just so low. And we're also seeing that there's less risk in bonds. There's less room for the interest rates to raise, means less room for bond prices to fall. So we kind of feel that the Fed is nearing the end of their rate hike cycle. Again, I don't think they're done, but the rate in which they're going to raise rates, we're maybe looking at 25 basis points here and there. But the frequency and the magnitude that they did last year, I think the majority of the Fed raising its rates is kind of done for the most part. Again, I think the majority of it's done. I think again it's still going to continue to go up a little bit until they kind of get inflation under control a little bit more. Okay, so in terms of the fixed income, here's some ideas. Okay, if you've got to keep money in cash, then high yield savings accounts can be a great thing. I'm not endorsing Capital One. I just happen to have a savings account there. They've got one at 3.5%. Okay, I'm not going to get rich making 3.5%, but it's better than nothing. Actually, it's 3.3%. So, but I just go on bankrate.com or do a Google search for high yield savings account and see what you can get. Okay. The other thing too is I kind of talked about this before, is that you can certainly buy short-term CDs. You want to keep your durations low. Shorter than 12 months, they'll provide the highest rates until the yield curve flattens out. So one of the things I've been doing for a number of my retired clients is that we're going to talk about this in a little bit. We call it the 3-bucket strategy, where you kind of break your portfolio down into conservative, moderate, and aggressive. Well, if you're retired and you're pulling money out of your account, so one thing that we've done is that we'll create an account that basically holds literally cash, and then we'll just ladder CDs. So we'll have like 3 months of cash, and then we'll buy a 3-month CD. So when that 3-month CD matures, that cash is there, and now you can spend that cash. And so we'll just ladder CDs, a 3-month, a 6-month, a 9-month, a 12-month. So you can like ladder CDs in the short term to make a little bit of money until you need that cash, and then boom, CD matures, and there you have it. So that's one thing you can do in the short term. And again, you can get 4.5% to 5% in the short-term CD right now. That's like, we haven't seen that in a long time. Okay. The other thing is that Series I savings bonds. You can literally go to treasurydirect.gov and you can buy some I bonds. And so between November of last year and April 30th this year, you've got interest rate of 6.89%. Now you can do, they limit you to roughly $10,000 that you can put in per Social Security per year. But the point is that, that's not bad. And so, again, those are government issued bonds that are yielding really nice competitive yields right now. So again, you literally just go to treasurydirect.gov. I cannot sell you those directly. You literally have to go to that website and buy them on your own, do it on your own, if that's the direction you want to go in. But, hey, buy $10,000 worth and have fun. The other one is, again, short-term government bonds, investment grade credit, and global bonds now offer some of the highest yields in the last 2 decades. And so these are some of the 6 areas that we're certainly focusing on in our fixed income portfolio. The other thing is that don't forget about fixed indexed annuities, okay? We've been finding with fixed indexed annuities, there are a number out there that are designed for growth. Again, I kind of put fixed indexed annuities in the safe tank, and you're not going to get the rate of return that you're going to get in the S&P 500. They're not designed to do that. Fixed indexed annuities are going to be more compared to bonds and fixed income, because your principal is protected and you've got upside potential of the market, but you're typically capped. But you know what? They're starting to kind of raise those cap rates a little bit. And so you might be able to get 5 or 6% in a fixed index annuity with your principal protected. So that's another tool in the toolbox if it makes sense for you. Okay. So those are some ideas in the fixed income space. Okay. The other thing I was going to talk to you about, and again, I brought this up to most of the people here on the call. As I mentioned before, one of the what I call the Swiss Army knife of financial products is cash value life insurance. And as most of you guys know, I'm a full service independent advisor. Again, I manage a lot of money, but I also equally believe in insurance products, because there's certain things that an insurance product can do that investments can do, and vice versa. So I just want you to kind of think about this concept real quick. And I just want to kind of remind you. So like, why would I want life insurance? Like, that doesn't make any sense to me. Well, you got tax deferred growth, you've got tax-free distributions, right? Because we look at taxable, tax deferred, and tax-free accounts. So the only other tax-free distribution is a Roth IRA and possibly muni bonds. So you got tax-free distributions, you got competitive returns. You also have riders that you can use to help pay for long-term care, chronic illness. You're not going to get that on a CD or something at Vanguard. You have collateral opportunities, so you can actually use your policy to make major, to buy major capital purchases. You can take loans and withdrawals. Again, so a policy, there's a guaranteed loan option. If you want to borrow money from it, you can. And guess what? These payments are unstructured. So you can pay yourself back or not. So you have flexibility right here. And then one thing is that so I'm actually updating my Social Security seminar, which many of you actually attended the webinar. But one of the things I talk about, but I'm really going to go into it in my next round of Social Security workshops, is that cash value life insurance is not included in provisional income. And that is a huge source of taxes in retirement, is the provisional income calculation, okay? And so I'm going to be talking about that in just a second. And finally, cash value life insurance gives you liquidity, use, and control, okay? So this was just a very brief refresher of some of the characteristics of cash value life insurance. I don't want to dwell on it, but what I'm doing in my personal finances, and I'm talking to a lot of you and a lot of my clients about it, is that we can actually use cash value life insurance as a part of the fixed income part of the portfolio. Okay. So if we can show you how to protect your principal, have a competitive return, grow that money tax deferred, and take loans and withdrawals on a tax-free basis, and that money doesn't count towards provisional income, the house Social Security is taxed, it starts to become a little more attractive. Okay. So one of the things, as you guys know, is that I'm a part of I've been part of a financial community called Money Tracks. And one of the things is that there's a conference in Orlando last January, and one of the speakers was the guy named Brian Bloom, and you see that book right there. It's called Confessions of a CPA, and basically what he showed was the capital equivalent value of life insurance, and there's a formula to it. So I'm actually working on a presentation right now that I'll let you all know about that kind of shows you the capital equivalent of life insurance. And you can compare that against any investment, 401k, real estate, whatever. But when you actually start looking at how powerful life insurance is and compare it to other investment that you have, including the ones that I manage, it's a pretty impressive story. And so anyway, I just want to kind of tease you with that a little bit. And that's something that we're going to be coming out with in the next quarter or two. Okay. All right. Let's kind of move on to equities and the risk tank. So I kind of showed you right here, kind of alluded that, we've had 26 negative years since 1926. But guess what? We've had 73% of the time since 1926, we've had positive markets. Okay. So we've had more sunny days than rainy days. Okay. If it's a rainy day, you just roll up the windows and put on your wipers. We'll get through it. Okay. So just like, again, I just want to kind of put things in perspective a little bit. Okay. And again, the idea is having that diversified portfolio makes sense. Again, we look at stocks, bonds, and a 50-50 portfolio. And in a 1 year period, yes, stocks, can drop. Here we go, 39% on the downside, but they can be up 47% on the upside, right? And then you have bonds also can be volatile, but you also see that 50-50 portfolio. Yeah, it can drop, but it still has a lot more upside potential. So yeah, we can see some fluctuation in the markets up and down, but the further you go out, those drawdowns become less and less, and you start getting out on a 10-year rolling period of time, is that it looks pretty consistent. So I just want to kind of put in perspective. Yeah, there's still diversification is important, and yeah, we're going to have years like last year that drop, but that's okay because eventually it's going to come back. Okay. And this is where kind of diversification can work. It can work, but it never feels good, right? So you've got, this is example after example. You go back to 2000, 2002, the SP was down -40, but diversified portfolio was down maybe -16. I'd rather be down -16 than -40. You can see we had positive years, and so the point is that a diversified portfolio, let's say a 60-40 or something along those lines. Yeah, it's not going to perform as well in an up market, but it's also not going to lose as much in a down market. Okay, so you can see that bottom line right there, the total return over a period of time, is that a diversified portfolio can actually perform, if not perform better than the overall market as a whole. So just kind of keep that in mind when kind of, this is where kind of taking a longer term approach can definitely pay off. And again, this is just a little piece I had on 60-40 returns. So you can see right there in 2022, yeah, we had a down year. But what I want you to look at is the previous years where a 60-40 portfolio had negatives. And what you can see is that the majority of the time, after a significant drop in a 60-40 portfolio, the following year was positive. Now, if you look at 2000 and 2002, that was one case that was, that didn't happen. But that was a prolonged bear market recession. Okay. Could it happen? Yeah, likely. I'm not sure. I don't feel a long-term, we're not in like a 2000 or 2008 kind of situation right now. So I think this, statistically speaking, I just don't see that happening. Could it? Yeah, but I think there's a small chance of that happening. And again, history suggests a rebound of these types of portfolios that I just kind of alluded to in that last slide. Okay. So what's interesting is that when the markets drop off, so where are the opportunities? Well, this is historical right here. So when you look at the markets 6 months out, 12 months out, 18 months out, what's typically done well? Well, you can see that U.S. growth versus value has tended to perform better shortly after a bear market recession. And you can also see, you just kind of look at the slide right there, that high yield bonds have typically done well the first 6 months, but again, look at the investment grades 18 months out down the road. So you can see that historically speaking, this is what we call sector rotation, when various asset classes will rotate. And this is really where having a professional manager who's looking at this stuff and who's able to make portfolio changes when we see the sector rotation, that's what's really important. So I think that that's one of the values that people such as myself and other managers can bring to the table, is that we're able to look at this stuff and find managers who are more tactical and who can adjust the portfolio accordingly to what's going on in the marketplace. So actually, I was just kind of looking at this, and Amy asked the question: so how do you lose money in a bond which is held to maturity? So great question, Amy. So you bring up a very good point. If you own an individual bond and you hold it to maturity, you will not lose value. What happens is that if you hold a bond, an individual bond, or a bond in a mutual fund or an ETF that is sold before it matures, you're selling on the secondary market, and that's where you can lose money. So how that works, Amy, is that if you buy a bond, I'll make it up, that has a 4% coupon, and I'll make it up, it's a 10-year bond or 20-year bond, it doesn't matter, and you want to sell it. But guess what? If I wanted to buy the same bond with the same duration, now it's yielding 4.5%. Well, why would I buy your bond at 4% where I could buy a new bond at 4.5%? Well, so in order for me to sell that bond to you, I've got to reduce the price to make it more attractive. So that's what it is. It's when bonds fall, they ultimately have to sell at a discount to be able to sell, and that's the reason why bonds kind of fall in a period of rising interest rates. Great question. Hopefully I answered it for you. So I also want to point out right here at the bottom of the slide, you've got emerging markets and international equities have also done very, very well. Now, what's interesting about last year, we actually saw that value stocks really outperformed growth. So you can see that, and we actually had a value tilt in our portfolios. So you can see, right there, that small cap value was one of the best performing asset classes in 2022. So now, what will it be in 2023? The chances are it may not be value. As we see, kind of historically speaking, growth has actually outperformed. So again, we have to kind of wait and see, and that's the reason why you have professional managers looking at this stuff to kind of see where the opportunities are and make sure that you are allocated properly and taking advantage of things. And again, what I typically do is use what we call a core satellite approach, where we have the core, let's say the S&P 500, but we have satellite positions around that in various sectors. And those sectors can rotate depending on what the markets are telling us at that time. Okay. So, and again, paradigm shift, you can kind of see again last year, and this is just another slide that shows you the same thing. We saw more strength in value than we did in growth. Again, by the way, I should have mentioned this at the beginning, but you guys, I actually have the handouts that you can download. Just go to the handouts and kind of download that stuff. Okay. Again, also dividend growers have historically dominated the landscape, and so you can see, just over time, as the Fed kind of raises interest rates, dividend stocks have typically outperformed the S&P 500. And again, that kind of goes into my conversations about the dividend plus strategy that many of you guys are either in or I've talked to you about. But it's, dividends have historically really, really done well in these types of periods and really outperformed the S&P. Next thing I want to talk about is also the dollar, and this kind of leads into my my international kind of talk. So one of the things is that the dollar has an influence on a lot of different asset classes, but primarily international stocks. So you can see as the dollar weakens, that actually helps out the performance of international stocks. So again, a weaker dollar supercharges non-U.S. stocks. You can see in the S&P gross returns, but look at the MSCI AFA. Again, you look at the gray box, that's the average when the dollar is down. Look how well it's done. But look at emerging markets on the far right. So since 2001, when the dollar is down, emerging markets have performed incredibly well. Okay, so this was one instance why we've actually put in a little higher allocation in our international positions, especially in emerging markets, because historically speaking, when you have a weaker dollar, these are the asset classes that tend to do pretty well. Okay. Again, look at global valuations. We also see that there's attractive valuations across the globe, and they've come in dramatically in 2022. So when we found that again, Europe has been really kind of affected a little bit more than the U.S. in terms of with Russia and the sanctions and gas and oil and so forth. So the valuations are looking fairly attractive on international positions. So the question is this a good entry point? Well, perhaps, right? I mean, this is some interesting perspective, right? Again, once a bear market or negative 20 has occurred, markets typically continue to sell off, with recessions experience larger drawdowns than non-recessions, okay? So however, the patient investors have historically been rewarded for staying the course over the following year. So, as I said, that's why we stay fairly fully invested, but we can have more of a tactical tilt to kind of be a little more defensive in the positions. But again, if you look at the S&P 500 averages following the initial 20% decline, 12 months later, and 18 months later, we're seeing some pretty positive results, right? So yeah, I mean, now is not a bad time to put new money to work. You just have to be selective on where you put that money. Okay, all right. So let's do a quick recap. So one is that, for fixed income, short-term CDs, I bonds, we see lots of opportunity in governments, investment-grade corporates, fixed index annuities, and cash value life insurance. Okay, and equities, again, diversify your portfolio with a tactical tilt, stay fully invested yet defensive. Okay, that's where that professional money management comes into play. Increase in your international exposure, high quality stocks, value and small cap. Okay, those are some of the areas that we like. Okay, so for those of you in retirement or kind of getting up to close to this, let's kind of talk about some strategies that could really kind of help you out. So I kind of alluded to this before. We call the 3-bucket strategy, and the idea with that is that you're just going to divide your portfolio into 3 different buckets. And so what happens is that when you need to pull money out of your account, you're going to pull that out of the conservative account. And then what that does is that allows time for your moderate and aggressive accounts to kind of rebound when the markets drop. Okay, so this is that whole risk tank, safe tank kind of philosophy that I was kind of alluding to at the beginning. Okay, so that's one way to do it. So I really like the 3-bucket strategy. The other thing that we take, another strategy is what we call the safety first approach, where basically you construct a floor of income from Social Security, pensions, and income annuities to cover your basic living expenses. And again, the higher your income floor, that means that you don't have to sell at a loss. Okay, that's a really important concept. Okay, and that's kind of what the safety first approach does. So you build that floor with Social Security, with pensions, and you may have something from an income annuity, or even taking distributions from cash value life insurance, although those may not be guaranteed, and might be a consistent source of income. So that's also another approach that you can take. The third approach is basically doing a combination of both, where you can take the 3-bucket strategy and layer it over the safety first approach. Okay, so This is actually my favorite approach, that we try to raise our income floor as high as we can, and then we can layer that 3-bucket strategy on top of that. And if you take this approach right here, you can absolutely navigate a bear market recession in retirement, okay? Because again, what we're doing in retirement is that we are literally converting assets to income. You need to think about income. That's the number one thing that's important in retirement. And by taking this approach, that's how you're going to deal with it, because the reason why you can't take out more money from a portfolio when the market drops is what we call sequence of return risk, or we call excessive withdrawal risk. And by taking this approach right here, you can really reduce those two risks very significantly. Okay. All right. I'm going to take a couple questions right here before I go on Secure. So Brian said, could our most analysis period right now, okay. Could the period right now be the 2001 to 2003 period after the Fed overstimulated the market prior to Y2K and overstimulated commodities and the business with cheap money for too long, which would mean multi-year decline versus historical norms? Could it happen? Yeah, but that's from what I've seen, and again, these reports that I have on my website with the BlackRock and Franklin Templeton, that's what you just, Brian. So is it a chance? Sure, but I don't think that's the likely scenario. But what if that is the scenario? We still have to construct a portfolio and a strategy to be able to navigate that if that happens. So that's where having that diversified portfolio, and so it's not only asset allocation, it's also asset location. Where are you going to put various asset classes within the safe and the risk tags, and what's the approach? So my point is that, I know, Brian, I mean, you're getting ready to retire fairly soon. So I think that's part of the approach, is that you really have to look at both those risk and safe tanks and say, okay, listen, if we turn out a little bit better than we anticipated, we still have our money allocated here in the risk tank that we can take advantage of those spikes, like I showed you in the first 6 months or 6 weeks of this year. However, if things drop, we need to have a strategy to get a little more defensive. So we could do that through tactical money management. We can do that by moving more money into the safe tank and protecting those principles. So we can look at it on a per account basis, but we can also look at it on an overall construction of looking at the aggregate of all the accounts that you have. So anyway, great question. I appreciate you asking that. Okay, so I've got 2 more sections, and then I'm going to call it a night. So we've got the Secure Act 2.0. So by the way, if you go to your handouts, I included one of the, I get all these white papers from these different sources. This was just one. It's got it's like, I don't know, 7 or 8 pages, and it's got some of the highlights. There are actually hundreds and hundreds of updates. I just kind of include the highlights right here, but there's a lot of them. I also included a 2023 tax summary, and also the handouts from the presentation. So you can, so please, download those handouts, right now before you forget it. Okay, now let's kind of talk about this pretty quickly. So these are some of the highlights of the Secure Act. 1, RMDs. So age 73. So they've raised the required minimum distribution age to age 73. I know up until this year, it was 72. So if you haven't reached age 72 by December 31st of last year, your RMD age is age 73. So that's great. It gives you another year to delay those required minimum distribution, and also do some of the tax strategies that we've kind of all talked about in terms of Roth conversions and those sorts of things. So that's pretty neat. And it actually raises to age 75 again for people reaching age 74 after December 31st, 2032. Okay, so for those sorts of people who are a little younger, The RMD age will be at age 75. Okay, so again, that really gives some more opportunity for younger people to do a lot of Roth conversions, and I think that's been sort of the trend legislatively is to really encourage people to do more money or to contribute more money to Roths and do more conversions. Okay. Again, one thing that's also really nice is that they've reduced the excise tax for the failure to take an RMD. It used to be 50%, and now it dropped down to 10% if you actually corrected it before the IRS imposes the tax. So, most people are aware that you got to do it, but typically if you miss a deadline, it's because there's a mistake or something happened with the custodian, like paperwork didn't get filed in time. The IRS understands you're trying to make an effort to make good, so they're going to they're going to try to reduce those penalties. And if not corrected within 2 years after the IRS assesses the tax, then the penalty jumps to 25%, which is still not as bad as 50%. Okay, so they're trying to be a little more gentle on that excise tax for the failure for taking the RMDs. Okay, but again, you must provide reasonable cause to IRS for failures to take the RMD to be corrected. It's got to be, you can't just say, oh, I didn't want to take it. Other thing we're talking about is catch-up limitations. Okay, so they're increasing. These are basically for IRA contributions. So starting next year, they're going to increase by $100 increments per year. So in 2023, if you're under age 65, the average and the limit, I'm sorry, is $6,500 a year. If you're over age 50 or 50 and above, it's $7,500. And so that should go up to $6,600 and $7,600 in 2024. So it's nice that they're raising those IRA limits. Okay. Higher employer plan catch-up limits. Again, effective this year, people over age 50 may contribute up to $30,000 in the qualified plans, 22.5 plus the 7,500 catch-up provision. So again, if you're 50 and above, you ought to be making those. You ought to be maxing out those 401k contributions or TSP contributions if you have the cash flow to do it. So that's really nice. Again, in 2025, the participants age 60 to 63 will be allowed higher catch-up contributions equal the greater of 10,000 or 50% more than regular catch-up contributions. So they're really giving people every opportunity to save as much as they can in their qualified plans. And again, the $10,000 is indexed for inflation beginning in 2026. This only allows for a 4-year, window. Age 63, higher catch-up contributions. Sorry, I got distracted by the heart. I encourage the emojis. So someone put a little emoji of the heart and the happy faces. So feel free to share the love with the emojis. So anyway, so I like that a lot. So there is actually a lot, when you actually read the Secure Act, there is a lot of really, really good stuff that got passed. So, which is remarkable given how just how dysfunctional Washington is. Well, this is one time where people got together and passed this legislation, put some good stuff in there. This is also really good too. Employers may now make matching 401k contributions into an employee's Roth 401k account, potentially allowing for the additional growth of tax-free retirement funds for a participant. Now, with that being said, the custodians and the 401k companies and the TPAs and all this, they have to catch up administratively to do this. But I offer a 401k for my company, and as a again, I'm the owner, but also a participant in my own 401k. Well, I absolutely want my employer contributions to go into my Roth versus the traditional. So again, I'd rather pay those taxes now and then have tax-free money down the road. So I think that is a huge thing to take advantage of. Also, simple plans and Roth IRAs, simple plans and SEPs, up until this year, there was not a Roth option. So now you can make Roth contributions. As I said, the custodians are still getting caught up with that. So I hold a lot of my stuff at Schwab. As of a few weeks ago, they didn't have the ability to to put Roth contributions to a simpler SEP, but that should be coming. So I just want to kind of give you a heads up on that. But again, I know a number of you, have simple plans or SEPs, and this would be a great opportunity to actually be able to put that Roth money in there. And again, for employers with a compensation in excess of 145,000, catch-up contributions can only be made to add Roth account provisions to this plan. So that's really kind of interesting. I've got to spend some more time kind of digging into these regulations, and as I do, I'll share this certainly with you. But I think with this new Secure Act, I think there's going to be some real opportunities to take advantage of some things. And again, this is super early in the new law being enacted, and so we'll certainly have more information on some of these changes in future market updates. So anyway, some neat stuff going on with there. I love this one. So if you've got a 529 that you've had it for at least 15 years, and hey, the kid's out of college, it's just kind of sitting there. Now you can roll over a portion of your 529 that goes into a Roth IRA. It's basically you're limited to the Roth IRA contribution limits, but it ignores the adjusted gross income limits. So for many of you on the call, you make too much money to make contributions into an individual Roth IRA. But in this case, that if you had money in an old 529 plan, you can actually roll that money over to a Roth up to the Roth IRA contribution limits. So that's a really cool new thing that just came out. And again, the maximum lifetime conversion limited to 35,000 for each beneficiary. All right, hey, I'll take it. Not bad. All right. Any other questions? All right, I've been here for an hour and 6 minutes, so I'm going to try to wrap this up in the next 10 minutes or so. But so one thing I wanted to kind of share with all of you is that we've talked about the markets, we've talked about opportunities in the portfolios, we've talked about some of the opportunities in the new Secure Act. But what it boils down to is that what is your financial roadmap? What are you literally doing in your strategy to make sure that you fulfill your goals and you live a happy life? Okay, so since actually a handful of you, I've kind of introduced this to you, but again, there's a bunch of people on the call who I haven't talked to you about this. But we have two new software programs that we've been using. One is called Income Solver. We actually got that back in October. What that does is it helps us to do distribution planning. So we can come up with all different strategies in terms of distributing various, different accounts that you have and come up with different strategies. So that's a really good software program. The one you're looking at right here is called Money Guide Pro, and we actually use this to help the retirement planning on figuring out what strategies make sense to get up to that point. Okay, so I'm starting to do reviews with clients, and one of the things that I'm going to be doing is literally everybody here on this call, I'm going to be reaching out to you to actually schedule a time to update your retirement plan, whether you are a client or not. That's, I'm offering, an hour call to actually let's take a snapshot of where you are, and let's kind of help you make sure you've got a good financial roadmap, and if you're on track. So this is a sample case that we have right here, where we just basically I enter some basic information, and then we spend the first little bit on your expectations. Okay, so and what this is designed to do is just to get you to think. Okay, so do you see yourself having some sort of part-time work in retirement? You're going to get a part-time job. Are you going to have an active lifestyle, quiet lifestyle? You plan to travel? You want to spend time with family and friends? Are you going to move out of state? Are you going to sell your house? Going to move somewhere else out of state or in state to buy another house? How do you envision your retirement? And for many people, this is the first time they've really kind of sat down and really kind of thought about it. I mean, I've sat there with couples thinking, well, what are we going to do? So it's designed to kind of get you to kind of think about what you want to do. And then we could actually put in there and say, well, if we're going to buy a new car, or if we're going to buy a new house, or if we want to create a travel budget, well, what should we budget for that? Should I budget, let's say I want to do one vacation per quarter. All right. Well, what do you want to budget to do that? You want to budget that like $3,000 or $4,000, a quarter for the travel budget? It's up to you. I'm just giving you examples. Okay. So we try to set expectations like, how do you see your retirement? What do you want to do? And we also see that we also identify concerns. Are you concerned about running out of money? Are you concerned about losing 20 or 30% in your portfolio? Are you concerned about, the death of a spouse? Are you concerned about any of these other things? Living too long, dying too soon? Okay. What are your concerns? Are you concerned about increasing healthcare costs? Many of us are at the age where we've seen our parents kind of go through long-term care situations. Well, is that a concern for you? How are you going to deal with it? How are you going to pay for it? Okay. So this process gets you to think, and it helps to identify your expectations and also your concerns. Okay. Yeah. And here they are. Here are money concerns. Not having a paycheck anymore, investment loss, spending too much. We've got health concerns, long-term care costs, a spouse living too long, dying too soon, having Alzheimer's. So these are all sorts of concerns. Again, this is just the top half of the page, but it goes on and on. Okay. So all that stuff is really important, and it gets you to kind of think about that. It helps to open up a dialogue to talk about this stuff. This is just an example. So here's some of the needs. Hey, the beach, healthcare. I want to buy another truck. Travel, college. It could be helping a grandchild save for college. It could be a child. Wishes, charitable giving, fund money, all sorts of things. So again, these are all different items that again are all kind of customized for you, right? So it's just a matter of kind of formulating what your needs and wants and wishes are. Okay. And then what we do is that, so we enter in all your different investment accounts. We enter in your Social Security. If you've got a pension, we'll put that in there. If you've got rental income, we'll pop that in there. If you've got income annuities, we're going to pop that in there. We're going to take literally every single account, every single source of income that you have, and we're going to model the situation. And this is what you're looking at right here. It's called Monte Carlo simulation, right? So it takes 1,000 trials. And you can see in this example, they got an 87% probability of success. So that's really good. Okay. Now, if you get into that blue zone, the really high one, that's really good, but it also means that you may be leaving some money on the table. So maybe you could spend a little bit more money or give more money to charity or your family. But, in other cases, it could be in the purple range where you're not on track. So you have a low probability of success. Well, if you've got a low probability of success, what are your options? Well, you can either try to get a greater rate of return, which oftentimes means bringing on more risk. You can save more. You could work longer, or you could actually live on less money. It's your choice. So for many people, getting a greater rate of return is not, there's not much you can do there because you don't want to risk too much. If you're saving money, maybe you can save a little bit more, but probably not more significant than you're doing right now. So many people, it's like, well, I got to work a little longer, or I got to reduce my lifestyle. Well, one of the things that I want to talk to you about in a minute is called the play zone, where we can kind of play with different scenarios and you can kind of see that. Okay. So what we're able to do here is that we're able to kind of identify these. So, we have our needs and we have our wants and we got our wishes. Okay. And we can kind of break it down. So if you want to have your basic things covered, we got that covered. But, the more you kind of pile on these wants and these wishes, it's going to require more money, which is going to reduce the probability of success of your plan. Okay, unless you have lots of money and that's not an issue. But for most people, their probability of success may get a little bit lower than they would feel comfortable with. Okay, so we'll actually kind of look at that. But all this is really important stuff because you can see exactly where you are, and we can identify the problems. Okay, you got to identify the problems before you can talk about the solutions, right? So we kind of look at this now, well, what are some of the recommendations? Well, this is where kind of working together, we can help kind of figure out what makes sense for you. Again, this is just an example, but I'm just explaining to you what the process is. So we get to this point, we see, are you on track? What's the probability of success? If it's not where you want to be, then that warrants further conversation, okay? Now, in the lower left-hand corner of the screen, you're going to see choices, play zone, what if worksheet, and super solve. So I'm going to come back to that in just a second. From my point of view, when I kind of talk to people, we go to the what if worksheet and we can put in different scenarios to say, all right, well, what if I delay Social Security at age 70? What if I move some of the money into an income annuity that I turn on at age 70? What if I used a dividend plus investment strategy where I can live off the dividends and not have to go into the principal and not have to worry about, the safe withdrawal rates? So what we can do is literally line up lots of different scenarios and show you a report side by side to which scenario makes the most sense. Again, this is a planning conversation. This is not a product discussion, okay? So what I kind of alluded to at the beginning was what we call the play zone. So once we enter in all this information, and now you have an idea where you are, at the end of our next meeting, I will say, hey, what username and password do you want to use to log into your own play zone, right? So we will literally create a username and password. I will email it to you so you can literally log into your particular plan and start playing with those sliders. So what if I retired a little later or a little sooner? What if my spouse retired later or sooner? What if I reduced my standard of living? What if I increased my standard of living? What if healthcare costs went up or down? And you can move those sliders back and forth. Well, maybe I'm going to have to cut back to 2 vacations a year versus 4. Okay, well, let's see that. So my point is that we're giving you the tools to take control over your own planning. Yeah, we're going to help you out, but it's just out of curiosity, just kind of put in the chat, is this something that you guys would use? Is this something that you would like to kind of play around in the play with? Just say, I would use it, or I wouldn't use it. I'm just kind of curious to see from you guys who are on the call, is this something that you would take advantage of? Just say, yeah, I would use it, or no, I wouldn't use it. Maybe I should have put a poll question in there. But I'd just be curious to see if this is valuable to you. So anyway, hey, thanks, Brian, for your participation. So ultimately, everybody's going to you're going to get to a crossroads, right? Everybody here on this call has a portfolio, and many of you have a fairly substantial portfolio, okay? So the question is, all right, am I going to stay the course with my exact portfolio, or am I going to maybe make a little change and to maybe make some adjustments and go a little different direction? So this is really cool. So look at this. Look at all you guys. Chuck would use it. Amy would use it. Tom would use it. Kevin would use it. Cecilia would use it. Brian would use it. A lot of you. This is great. Well, that makes me feel good. So yeah. So again, that's what we'll literally do on our next meeting, is that we'll update all this kind of stuff, run some comparisons, and we'll give you access to this stuff. Don said I'd use it too. Great, Don. Awesome. Okay, so again, the whole idea is that you need to know what your options are. The only way to know if there is a better option is to compare and contrast. All right, so that's where these different scenarios are. So if you see up there, you see the left side, you see here's the current scenario. This is the path that you're on right now. This is your current portfolio. And then we also look at what's the average return. What if we had bad timing? What if the like we have maybe this bad bear market recession just turns ugly and just drops another 20-30%? What if that happens? Well, let's see how that affects the portfolio. So you can kind of see right here, that, again, this is just an example, but you can kind of see here, hey, they got only a 69% probability of success, but what if we change Social Security and instead of taking that at your full retirement age, we bumped it to 70? Well, boom, that had just increased your probability of success by 6%. Well, what if we added, a dividend plus scenario where we're living off those dividends? Well, boom, now we just increased that to 77%, right? So the power of the planning right here is that we're able to take your current situation exactly the way it is and say, hey, well, here's some ideas. Let's throw them in there as different scenarios and let's see what turns out to be. So just kind of give me a love emoji if you think that would be great. Just kind of give me down at the bottom. You see like the little heart. Just kind of give me a little love if you like that idea. I don't know. I'm sort of a geek. I kind of like that stuff. But hopefully you guys kind of see the power. I just want you to feel that you can take control of your own finances and put yourself in a better position. All right. That's what I'm trying to do, guys. I'm trying to give you control and so I can empower you with the tools to take control of your finances. That's ultimately what we're trying to accomplish. Okay. So anyway, that's basically that. In terms of the value proposition, again, there's some new people here on the call that may not be familiar with me, but just again, I suggest you go to my website. But again, we're just a full service investment advisory and financial planning firm. Again, I specialize in retirement income planning. That's my gig. That's all I do. I don't do mortgages. I don't do accounting. I don't do college planning. My specialty is retirement income planning. And I literally meet with over 100 people a year, and I do it really, really well. And as you kind of get an idea, is that the planning process drives everything. Again, our job is to guide you through the process to help you make well-informed decisions. Okay. All that stuff I talked about at the beginning of the presentation, where the markets are going, how to I guess allocate the risk in the safe tanks, all the Secure Act, all that stuff is super important, right? But that's the world that we live in, and those are the sorts of things that we have to take into consideration. But before we even get there, we have to go through this Money Guide Pro, software and take a snapshot and see, hey, where are you going? So if you're going to get in your car and drive from DC to LA, or maybe go to or somewhere on the West Coast, okay, you want a roadmap. You can kind of head west just by looking at a compass, but that's not the best way to do it. So the process is the most important thing, and that's what drives every decision that you make. Again, reducing taxes is always a major consideration. Okay, this is a big deal. So most of you, or let me say this, people in general, when they look at their portfolio, they look at, well, what kind of rate of return am I getting? What's the market doing? Okay, all that stuff is important. Rates of return are important. But what I can tell you is that if the S&P 500 goes up 10%, is that what you're making? No, you're actually getting the 10% minus the taxes. So if you've got to pay capital gains taxes, short long-term capital gains, if you got to take distributions out of a qualified plan, you're going to be paying taxes at your ordinary income tax rate. So that 10% rate of return is not 10%. It's going to be less because of the taxes. Okay. So when we do planning, we always take taxes into consideration. And again, that's one of the biggest wealth transfers that we have. So again, we can show you how to keep more money in your pocket by reducing taxes. Would you like to have that conversation? Okay. We also provide weekly, monthly, quarterly market updates. You're on a quarterly market update right now. Okay. So, this one's going a little longer than I normally do, but we had a lot to cover with the Secure Act and also some other things. So as part of our value proposition is that I do a lot of education, and I want to make sure you guys are educated so you make educated decisions. Again, we offer annual reviews and update the plan to make adjustments whenever needed. So as I said, if I haven't scheduled a review with you on the call recently, then we're going to be reaching out over the next 4 to 6 weeks to schedule one. So again, I'm literally, and I've got over 200 clients. I'm literally reaching out to every single client to schedule a review to take them through take them through the Money Guide Pro software. Okay. So again, this is an important thing. So again, you guys who are on the call who are not clients of mine, I'm going to offer you the same opportunity to kind of take a snapshot and put our stuff through the Money Guide Pro. And again, we're always obviously available to answer any questions that are not related to your investments. And so again, yes, we do planning, but in many cases, like, hey, listen, should I refinance my house? I'm thinking about selling my house in Maryland and buying something in Florida. Or, hey, I'd like to help save for college education for my grandson or granddaughter. What are some ways of doing that? So anyway, these are the kinds of things that, again, I'm available to answer questions that go far beyond the, just the investments. And again, I'm just kind of wrapping things up. So again, I'm about an hour 25 into it. So if anybody has any questions, you can also put that in there, put this in there. And I also, one thing that I want to put in here is that I want to put this in the chat. Say this is the link to my calendar. Okay, so I just put in the chat a link to my calendar right here. And so if you guys want to schedule, again, a complimentary 1 hour Zoom call, go ahead and do it. My calendar is a little full here and there. I'm actually taking a well-deserved little short vacation at the end of next week. But anyway, but you could certainly kind of book that. We could do some time there. Maybe that's one of the views of possibility of stagflation. That's a great question. To be honest with you, Amy, I don't have a strong view on that. I'm relying on the institutional managers to construct portfolios to kind of address that. The bottom line is that there's great opportunities in bonds and there's great opportunities in stocks. And if you've got things set up correctly in the risk and the safe tanks, we can get through anything. So I don't mean to be dodging your question, but to be honest with you, I don't have a strong opinion on stagflation. Anyway, any other questions that people have before we kind of wrap it up here? So again, there's my phone number to the office. There's my calendar link. If anybody has any other questions, feel free to ask them. But if you guys don't, I really appreciate you hanging with me for about an hour and a half. And just kind of put in the chat if this was helpful to you. I always love to get feedback. And also, I will be sending out an email with a copy of the video of the presentation. And so anyway, you can watch it if you want to fast forward it or whatever. But the biggest thing that could help me out is just introduce me to other people who you feel could use this information. So I appreciate your time tonight, and hopefully this was helpful and you learned a thing or two and you have a better idea of what's going on in the markets or our views on things, and hopefully you take advantage of our complimentary our Zoom meeting. Kurt, thanks for joining us. I'll see you at the racetrack in about a month or so. And anyway, I certainly look forward to talking to you guys soon. So, all right, guys, have a good night. And I thank you for joining us this evening. All right, take care.